Hello students, today I'll be teaching you the redemption of preference shares. But before we start with redemption of preference shares, I'll give you some knowledge about issue of shares. Okay, so we'll start now. There are a few terms which you should know before we proceed with the chapter. Number one, share. So what is a share? Share is nothing but a share or a part in the share capital of the company. Okay. Next term is face value of share, the nominal value of any share or the basic value at which the share is registered is called as face value of share. The original price of share is called as face value of share. Market price of share, it is a price at which the share is traded in the stock market. It's called as market price of share. Issue price of any share, it means the price at which the share is sold by the company in primary market is called as issue price of share. Okay. Now, what is issue of share? Issue of share means selling your shares to general public. It's called as issue of shares. Okay, and the price at which it is sold is called as issue price of that share. The redemption of preference shares, the share capital, preference share capital is for a limited time. So when it is repaid, it is termed as redemption of preference shares. Okay. Normally, equity shares are issued for a lifetime, but in some cases, the equity shares can be bought back. It's called as buyback of equity shares. Okay. Now, let us see what are the categories or classification of share capital. The topmost at the ladder we have authorized share capital. It is also known as nominal share capital, or sometimes called as registered share capital. Okay, it is the maximum amount which can be raised through share capital. Okay, so authorized share capital is at the top of the structure. Out of this share capital, some portion is sold to public. It is called as issued share capital. Okay, some part is not issued, is called as unissued share capital. Okay, out of issued share capital, most of the share capital is purchased by the public. It is called as subscribed share capital. And the remaining is called unsubscribed. Clear? Now, once shares are subscribed by public, the directors have right to call money on that share capital. When people apply for share, they pay certain amount. Say, for example, 25% of the issue price is paid at the time of application. Okay, so once a person buys or applies for these shares, okay, he has subscribed the share capital. Now directors have a right to make call on those shares. Clear? So the portion of subscribed capital which is called up by the directors is called as called up capital. The remaining is called uncalled capital. Sometimes directors keep aside certain amount of this subscribed capital, which will be called up only in case of winding up of the company, that is closing of the company. Okay, it's called as reserved capital. Okay. Now, out of this called up capital, mostly people pay the amount which is called up by the directors. Okay. So that portion is called as paid up capital. Okay. And some portion may remain unpaid out of called up capital. It is called as falls in arrears. Falls in arrears. Clear? So I'll explain it once again. At the top, we have authorized share capital, also called as nominal share capital or registered share capital. Out of this, some portion is issued to public for subscription. That portion is called as issued share capital. Clear? And the remaining is called as unissued share capital. Out of issued share capital, people may subscribe or purchase the shares. The portion which is purchased is called as subscribed capital, and the remaining is called unsubscribed. Okay. So subscribed capital is part of issued capital. Okay. Now, once you have subscribed capital, you are liable to pay all the call money which directors have called upon. So the portion of subscribed capital which is called up by the directors is called as called up capital, and which is not called is called as uncalled capital. Okay. Sometimes certain amount is kept aside to be used at the time of winding up of the company. It is called as reserved capital. Clear? Now, out of called up capital, normally people pay the amount which is called. So that portion which is paid is called as paid up capital. The amount which is not paid is called as calls in arrears. Then I hope this is clear. We'll move on to see, these are basics. You should be aware of these. Then only we can proceed further. You will understand it better. Okay. Next is now I already told you what is face value. That is original value. Now the shares are sold to public, maybe at same price that of face value. Such a issue will be called as issue at par. Okay. If face value is 10 and you are issuing same at 10 price, 10 rupees, it will be called as issue at par. If you are selling your 10 rupee face value share for 15 rupees, it is said that you have sold it at a premium. Okay. In some cases, the share can be sold at a discount. So it will be called as issue of shares at a discount. Now this price, which is issue price, okay, can be collected from public maximum in 4 installments. Nowadays, they call the entire amount at the time of application only. Now that is the practice. Okay. But maximum there can be 4 parts in which the money can be called up. Okay. So if there is 100 rupee share, suppose the issue price is 100 rupees, you may ask people to pay 25 rupees while applying for those shares. Okay. Then when they apply, then you decide to whom shares should be given. So accordingly, you allot the shares. When you allot the shares, you know the shareholders who have become shareholders. Now you ask them to pay next 25 rupees. Okay. You send a letter that you have been allotted these many shares. Please pay 25 rupees per share. So this is called as allotment, and the letter is called as allotment letter. Clear? Suppose you have issued a share of 100 each. You may call some portion. Okay, that is 25%, 25 rupees at the time of application. When you receive applications, then you start allotting the shares to applicants. Okay. At that time we send allotment letter, and at that time we ask them to pay certain amount. Say for example 25 rupees, next 25. Okay. So it's called as allotment money. Okay. After say for example another 1 month, you make a call that you pay another 25 rupees. Okay. That's called first call. And at the end you may ask them to pay the balance 25 rupees. That's final call. Okay. So this way amount can be collected. Okay. The issue price can be collected. As I told you that issue price can be higher. That is in sometimes in case of premium, it can be 125 instead of 100, it will be 125. So that 25 rupees extra may be collected at the time of application, allotment, first call or a final call. Normally, if nothing is mentioned, we take it in allotment money. Okay, if nothing is mentioned. Clear? If nothing is mentioned, premium and discount is adjusted in allotment money. Okay, students. So this was basic for issue of shares. Now I'll issue journal entries in case of issue of shares. Very necessary, because based on that redemption interest will be there. Okay, so I'll just write down the entries. Very simple entries, don't worry at all. Okay, even if you don't know the entries very well, you don't know the logic and all, still you will be able to solve these entries. Okay, so as I told you, there are 4 stages in collecting capital. Okay, first is application. Clear? Next stage is allotment. Then first call. And second or final call. Okay. Okay. Now in stage of application, okay, people apply for shares. Okay. We'll consider 1 share of 100 each. Face value of share is 100 and we have sold it for 100 only. Okay. So what is the first entry in the process? That you receive money, or you receive application money from public. Okay. So when money comes in, it is deposited into the bank account. You can't collect cash. Okay, you have to collect via bank. So bank is receiving the money. So always this entry is fixed. Okay, whenever application money is received, entry is fixed. What is the entry? Bank account debit. To suppose it is equity share capital, you will write equity share application account. Very simple. Okay. These entries are fixed. Only amount will change. Clear? What I told you, the first stage is application, second is allotment, third is first call, and then is fourth is final call. Clear? So the process starts with people paying application money. We have to write all the entries from company's perspective. Okay. So what company will say? Money is deposited into my bank account, and this money is for equity share application. So entry becomes bank account debit to equity share application account. Clear, students? Then next entry, when you receive money on shares, what you do? It belongs to share capital. So you have to transfer this to share capital. Okay. So I'll write here, it was money on application. So you can write application if you want, being application money received. Okay. Now this application money is nothing but a portion of your share capital. So it has to be transferred to share capital. Okay. Clear? So from equity share application, you will transfer this amount to share capital. Okay. So see, always remember, whenever you are making or passing a transfer entry, okay, the account which you are going to use should be on the debit side, and to whom, to the account to which you are transferring will be on the credit side always. Okay. You are transferring from equity share application, so it will be debit. Equity share application account debit. You are transferred to share capital account, to equity share capital account. Clear? Very simple entry. Understood? I am teaching only basic entries, few entries. Okay. So on application, you have to write these 2 entries. Okay. Sometimes you may receive excess application. What? Okay. Sometimes, what I said, sometimes you may receive excess application. In that case, first entry will be reversed. When you received application money, what was the entry? bank to equity share application, and when excess is refunded, entry will be reversed. Equity share application to bank. Okay. Okay. So basically these two entries are important. First, you received application money, and second, you transfer it to share capital. Clear? I hope this is clear. Okay. Now, in case of allotment, first call and final call, the order will be reversed. Okay. First, you will make the transfer and then you will receive money. Okay. In application, first you received applications and then you transfer it to share capital. But in now next three stages, okay, that is allotment, first call and final call, the transfer entry will be done first and then money receipt entry will be there. Okay. So what was the transfer entry in application? Equity share application to equity share capital, right? Equity share capital is always credited. Remember this. Okay. Now we are transferring allotment money. Actually, we are making allotment due. Okay, also called as transfer entry. Okay, so I'll be writing equity share allotment account debit to equity share capital account. Allotment money becomes due. Okay. Clear? See, it is similar to your transfer entry, the second entry in application. Okay. Clear? Very simple entries. Entries won't change ever. Okay. These entries will remain as it is. Amount will differ depending on number of shares and the value. Clear? Okay. Now you have sent a letter. See, when we pass this entry, it is presumed that we have sent letters to the applicants to whom allotment is made. Okay. Now we have identified our shareholders, that these are the shareholders, and this entry is passed, and we have let them know that you have been allotted shares and you are required to pay the next 25 rupees per share. Clear? So this entry signifies that allotment is made, the people are identified, and we have asked them to pay. Clear? Now they will pay money. Okay. So what entry will be passing? Money is coming in. So first entry, when we received application money, same way we have to pass entry for allotment money received. So entry will be bank account debit which money we are receiving? Allotment money. Okay, so it will be to equity share allotment. Clear? Very simple. Now these two entries will be repeated for first call and final call. Same entries. Okay, in case of only in place of allotment, I'll be writing first call, and in case of final call, I'll be writing final call. That's it. Otherwise, entries are same at both the places. See, I'm just copying it as it is. I'll replace allotment with first call. Okay. So here, equity share, instead of allotment, I'll write first call. Clear? Very simple. Okay. Even if you know first entry, you can pass the remaining entries. Okay. And when you will receive money, it will be bank account debit to equity share first call. Clear? Now same way for second call or final call. Again same entries. Instead of writing first call, I'll be writing final call or a second call. Anything is fine. Clear? I'll just change it. In second entry also, I'll write money received, bank account debit to equity share, final call. Clear, students? I hope this is clear. Okay. You need to know entries for issue of shares. Then only you will be able to write entries for redemption. Clear? Okay. Now what I'll do, I have shown you this when share is issued at par, that is face value is 100 and issue price is also 100. Clear? Now sometimes, as I told you, share can be issued at a premium. Okay. And I told you that the premium is normally collected at the time of allotment. Okay. So what is the difference then when money, that extra 25 rupees, is collected on allotment? What will be the change? There will be only one single change. Okay. As you are receiving money not only towards equity share capital but also towards security premium. Okay. So in second entry, in allotment entry, your entry is equity share allotment to equity share capital. Okay. But you are collecting not only equity share capital plus premium also. So one additional credit will come to securities premium amount. That's it. This is the only change if premium is there. Okay, very simple. Okay. I hope you have understood this. Clear, students? Okay. And when money will be received, it will be as it is, bank account debit to equity share allotment. Okay, the full amount. Clear? Okay. Now one more variation I told you. Okay, that sometimes money may not be collected on some shares. Okay, it is known as calls in arrears. Say for example, first call money is not received on certain number of shares. Okay, call money is not received on certain number of shares. I'll just insert column here. Let us presume that our first call is of 10,000 rupees. Okay, 10,000. Okay, if everybody pays in bank, you will receive 10,000, right? And it is on account of call. Clear? So this way the entries will appear. Clear? I haven't done here debit and credit. Just for understanding purpose, I have made this column. Clear? If you want, I can make one additional column for debit and credit so that you don't have any confusion. Okay. Like this, right? So we have made first call. Okay. Entry is first call to equity share capital, 10,000 each. And then you receive money on first call, bank account debit to first call. Clear? Now suppose you did not receive the entire money. One shareholder who had to pay 1,000 rupees did not pay. So what will happen, students? If a shareholder who had to pay 1,000 rupees out of this 10,000 total amount, he did not pay it. So in bank, can you write 10,000? No, obviously. You will write only 9,000 because 1,000 is received less. So where will that be recorded? 1,000. Well, that will be on the debit side. We'll call it calls in arrears. Okay. Very simple. Because both the sides should always tally debit credit. Okay. So out of 10,000, if you could receive only 9,000, so against bank you have to write only 9,000. So where that 1,000 will go? It will go to a new account called calls in arrears account. Clear? So this 1,000 is your arrears. Understood? Okay. Now in example, in sums, if you are told that Mr. A did not pay first call money, then what about second call money? It is not mentioned. You have to presume that in case he is not paying first call, even he won't be paying second call either. Okay. So same way you have to pass entry for calls in arrears at the time of second call. Clear? That's it. So this was issue of shares for you. One more part is there. I'll show you that also so that this issue of share part will be over. I hope you have understood this, what I have taught you. Okay, you can repeat the lecture and watch it again to understand it better. Okay, you can try these sums. Now, I'll teach you 4 features of shares. Okay. Many students said that forfeiture is very difficult. Not at all. I'll tell you. Okay, we'll just see it now. So first, what is the meaning of forfeiture of shares? Well, forfeiture means cancellation of shares. Okay, forfeiture means cancellation of shares. A share can be forfeited only on account of non-payment of call money. Okay, if you don't pay any call, first call, second call, or even allotment money for that purpose is considered as call money. Okay, any money which is called and you have not paid it, then your shares will be forfeited. Clear? There can't be any other reason for cancelling the shares. Okay, the only reason for forfeiture or cancellation of share is non-payment of call money or allotment money. Clear? Now, what happens when shares are forfeited? Okay, when shares are forfeited, the share capital is cancelled. The share capital is cancelled. Students, you must have observed in above entries, you can see the share capital is always on the credit side. Okay, check it. In all the entries, share capital is always in the credit. In entry, it is always on the credits. Okay, see the first entry in application, in second entry, equity share capital is written on the credit side. 2. 2 indicates credit. In allotment first entry, 2 equity share capital. In first call, second call, 2 equity share capital. Because share capital is a liability, a credit balance. So it will never be debited. It will be debited only when shares are forfeited. Okay, very simple logic. Okay, so as I told you, when shares are forfeited for non-payment of call money, share capital account will be debited. Clear? Understood? So equity share capital account will be debited. Okay. Say for example, we are cancelling shares worth 10,000 rupees. Okay. So now we are cancelling shares worth 10,000 rupees. That person who had not paid 1,000 rupees of call money, okay, he had total shares of 10,000. Let us take it 5,000, not to get confused with other 10,000 figures. Okay, suppose he had shares worth 5,000 and he could not pay 1,000 rupees. Okay, and 1,000 on second call. I told you, if he is not paying first call, obviously he won't be paying second call either. Clear? So now his share capital will be cancelled. Share capital always has credit balance. So now it will be debited. Clear? So I have debited share capital. Okay. So when we had past entries, okay, those entries we have to reverse for this person. Okay. We have to reverse those entries for this person. Okay. Now you can see calls in arrears. When we see call in arrears in third entry, third column rather in first call, you can see call in arrears is in debit. How much? 1,000 rupees. Okay. So same way, 1,000 will be there in final call. So 2,000 rupees he has not paid. Okay. And in entries, it was on debit side. So now it will be on the credit side. Yes. So I'll write 2 calls in arrears. Student, let me tell you, in this entire chart, whatever entries I have shown you, not a single entry will change ever. Only figures will change. Entries remain as it is. Figures will change depending upon number of shares and amount paid up or called up. Clear? Okay. Okay. Now, as I told you, we have cancelled his share capital of 5,000 rupees. Okay. Out of that, 2,000 he had not paid. Clear? But what about 3,000 which he had paid? Okay, it is transferred to share forfeiture account. Okay, how much amount? 3,000. Suppose he had paid 3,000 rupees. So now it will go to share forfeiture account. Clear? So it is kind of reserves for you. Okay. So when share is forfeited, very simple. Debit share capital account. Share capital always credit in all the entries, but when share is cancelled, we have to cancel that capital only. So we are debiting it. Clear? Very simple logic. So share capital account debit. Okay. Calls in arrears were on the debit side because we had to receive them. We have to recover those. Okay. So debit indicates asset. So we had to collect that 1,000 rupees plus 1,000 on second call. So those were on the debit side that we have to recover. But when we cancel it, do we retain any right to recover those? No. So we have to now cancel that right of calls in arrears. So we are crediting that calls in arrears now. Clear, students? Just keep it simple. Whenever shares are forfeited, we are cancelling share capital. Share capital always has credit balance, so we will debit it now. So equity share capital account debit. Okay. 2 calls in arrears that we are cancelling our right to collect that arrears from that member. What about those 3,000? Now that belongs to company. We need not repay to that person. So it kind of reserve. Share forfeiture account is kind of reserve for us. Clear? So this is the only entry for share forfeiture. Clear? Now, when you cancel share, it will reduce your share capital, isn't it? This is just an example of one shareholder. There may be many such shareholders, and as a result, there can be a reduction in the value of share capital for a company. So what company does is it reissues these shares to another person. It is called as reissue of shares. Okay. Forfeiture and reissue are two different things. Forfeiture means cancellation. For that, only one entry is clear. Now we can reissue those shares. Okay. We'll reissue those shares. Now, since we already completed the procedure of application allotment, what company does? It calls for the money in one shot. Okay. Only one slot, it calls for the entire money. Okay. These shares are for 5,000 rupees. So company may sell it for only 4,000 rupees. 1,000 discount it may give to the new buyer. Okay. So he will pay 4,000 rupees, but he will receive shares worth 5,000 rupees. So he is gaining 1,000 rupees, but company is at a loss of 1,000 rupees, isn't it? Okay. Let us pass the entry for this. Now, when company will sell this share, company will receive money, isn't it? Company will receive money. So whenever company receives money in bank, what account will be debited? Obviously bank account, isn't it? Bank account debit. Clear? How much money bank company will receive in bank? 4,000. Okay. And we are giving away shares. So share will be credited. Equity share capital will be credited to equity share capital, and amount will be 5,000. So what about that 1,000 loss which company is going to suffer? Well, this loss will be made good out of that share forfeiture account. Okay. See, we had received that 3,000 from that earlier shareholder. So that was kind of reserve for us. Now that reserve can be used to write off this loss. Okay. So you can use a share forfeiture account to offset this loss. Clear? So this was entry for the reissue. Okay. There is only one entry for cancellation of share capital. Clear? Now those shares are reissued. Clear? So this share forfeiture account, which had 3,000 balance, we used 1,000 out of it. So now still 2,000 is left in that forfeiture account, and those shares are no more forfeited. They stand as if they are a share capital. So that balance 2,000 in this share forfeiture account will be transferred to capital reserve account. Clear? So the share forfeiture account had a credit balance of 3,000. 1,000 debited in second entry in ratio. So still in credit it has 2,000 Okay, so we will debit it by 2000 so that it nullifies. Okay, so I'll write share forfeiture account debit to capital reserve. How much balance it had? 2000, right? That 2000 will be transferred to capital reserve. That's it. So these three entries can be said that relate to forfeiture, but for forfeiture only one entry is there, single entry. Okay. I hope you have understood this. This was the entire chapter. Okay. Most important part. Okay. Many small entries are there, like issuing shares for consideration other than cash. Many things are there, but the portion which relates to your redemption of preference shares and redemption of debentures is covered here. Okay, students. So this was very important. I had to teach you this before going for the chapter redemption of debentures. Clear? So I'll start with now the redemption of preferences. Rather, I'll start with preferences. So I told you what is redemption. Redemption means repayment of preference share capital. Okay. So when company repays preference shares, okay, in that case, the debenture holders or the borrowed funds may raise an objection. What is the objection? That before paying a liability, how can you repay your capital? Okay, that's a big objection, isn't it? Okay, when you have already learned dissolution. Okay, in dissolution, we pay first the outsiders, isn't it? Even in piecemeal distribution, we saw that we pay outsiders first. We pay preferential liabilities, like government dues, okay, taxes, employees dues. Then we pay loans. Then we pay partners loan, and at the end we pay capital. Okay, what is the logic? The logic is that the owners cannot take away money before paying the liabilities which are accrued during the course of business. Okay, so when companies redeeming preference shares, in fact, it is taking away part of its capital. Okay, so it is not allowed. So what company can do is they can issue new type of shares or same type of share, okay, and keep the share capital intact. Okay, so it can be done in many ways. See, the basic thing is that they have to keep the value of share capital intact. Okay, say for example, the face value of redeemable preference shares, which company is going to redeem, is suppose 1 lakh rupees. Okay, then what company should do? Either they should issue new shares. They should issue new shares. Of the same value, that is 1 lakh. Okay, this is simplest way out. Then you issue new shares of 1 lakh rupees. Okay, if preference shares were due for redemption, you issue new shares. It can be preference share, equity share, it doesn't matter. But you issue new shares. It should form part of your share capital. Then it's okay. You brought in new capital and you redeem your old capital. That is 100% okay. Okay, so that is one way out. Another way out is if you don't want to issue new shares, okay, that is 0. Then what is another way out? Another way out is you can create a CRR. CRR stands for Capital Redemption Reserve. Okay, also called as CRR. So CRR is considered as good as capital. Why? Because using this CRR, Capital Redemption Reserve, you can issue new shares, bonus shares, or you can make partly paid share into fully paid share. Okay, so in fact, it is as good as bringing in new capital. Instead of asking new shareholders to pay money, okay, the money which belongs to shareholders in the form of reserves, it is used to issue new shares. Okay, in the way of bonus shares or making partly paid shares fully paid. So that again, the share capital is raised to the original value. Okay, so I was telling you about capital redemption reserve. So this reserve is created out of free reserves or divisible profits, we call it. Okay. So what is divisible profit? Profit which is earned during regular course of business is called as divisible profit, or the profit which can be distributed among the shareholders by way of dividend is called as divisible profit or free reserves. Okay. So as I told you, if you are not interested in issuing new shares, what you can do is you can raise CRR to the extent of 1 lakh rupees. That will do. Okay. So any one of these is fine with the borrowers. Clear? So you have two ways out. Either you issue new share capital worth or equal to face value of preference redeemed, or you create a CRR worth same value as you are redeeming the face value of preference shares. Clear? Or sometimes you may go for both of them, like part by way of new shares. Say for example 50,000, I'm issuing new shares, and for 50,000 I'm transferring from free reserves. Okay, even this combination is fine. Okay, but we have to make sure that the right hand side issue of shares plus CRR is at least equal to left hand side. Okay, the issue of shares can be higher also. It need not be equal. It can be higher, but it cannot be lesser than. Okay, so if there is an issue of new shares worth rupees 2 lakh rupees, then it's fine. No issues with that. That is fine. Okay, new issue can be greater value of a greater value. That is fine. No problem. Clear? But minimum 1 lakh should be raised. Okay, that is the face value which you are going to redeem. It should be made intact, either by issuing new shares. Now, new shares can be preference or equity. Both are fine. Okay, there is no compulsion that there should be issue of equity only or preference only. Okay, it can be both. Okay. Okay. Now, I'll just tell you what are free reserves. So free reserves, okay, will include P&L account, revenue reserves, general reserve, dividend, equalization reserve. Okay, sometimes sinking fund. Sinking fund is a kind of reserve which is kept aside for some specific purpose. And suppose that purpose is over, then whatever balance is there in sinking fund can be used to be transferred to CR. Okay, so they will mention whether the purpose for which it was created is over. In that case, you can use that sinking fund. Okay. The reserves which you cannot use will include, okay, it is not free reserves. one capital reserve. Again, some conditions are there. Okay, securities premium, then CRR which we created right now. Okay, so same way, if few years back or few months back, if you had few years rather, you had redeemed some shares, and at that time, if you had created CRR, then that was for specific purpose. So if that is there in your balance sheet, you cannot use it because it is earmarked for some purpose. So these reserves you cannot use. Okay. Same way, revaluation reserve also you cannot use. In case of revaluation reserves, some conditions are there in which you can use. Okay, like if you have realized revaluation reserve in cash. Okay, like suppose you had revalued your land. Okay, you had made a profit of 1 lakh rupees. You cannot use it. But suppose that land is being sold and that profit has actually materialized, then you can use that reserve, revaluation reserve. Okay. Even in case of capital reserve, if capital reserve has realized in cash, okay, you can use it. Okay, that's it. Now I'll tell you entries for redemption of preference shares. Okay, just like I told you for issue of shares, I'll give you entries for redemption of preference shares. Okay, just give me 2 minutes. You are understanding the chapter, not that difficult. I'll take a couple of thumbs, not today, maybe tomorrow. I'll just give some entries, which I'll explain right now. Okay. So tomorrow we can start with the sums. Okay. I'll do all the important sums so that we can practice those. Okay, before exam, because only 1 week is left. Okay, for your exams. Okay. One more small part I would like to show you. Okay. Now, as I told you that in case of issue of shares, we saw that a share can be issued at par, at premium, or at discount, right? So same way, in case of preference shares, we can redeem preference share at par or at a premium. We cannot, definitely no one will agree for redemption of preference shares at a discount. Okay, so sometimes the company may redeem the preference shares as a goodwill gesture at 10% premium. Par is normal. Everybody will definitely pay the liability value. But sometimes some companies, as a goodwill gesture of goodwill, they may give away 10% extra of face value. It is called as premium on redemption. Okay. So premium on redemption is loss for the company. Okay. Now it has to be written off against some reserves. Okay. Clear? So I'll show you that. While solving, students, you have to make this equation. Huh? I'll make it bold. So whenever you are solving this redemption of preference share sum, make this equation, okay, and one equation of premium on redemption. If you are repaying preference shares at a premium, only in that case this additional equation is required. Okay, all right. Premium on redemption. Okay. Now, as I told you, premium on redemption is also a loss. Okay. Say for example, the preferences are redeemed at 10% premium. So 10% of face value we have to calculate. So it will be 10,000, right? Above we have face value as 1 lakh. So 10% of that will be 10,000. So you are suffering loss of 10,000. Now this should be made good out of first use security premium. Okay. So you can use security premium to write off this premium on redemption. See, security premium means when you issued shares, you sold shares to public at a higher, that extra premium you had earned. Okay, that profit you can cancel out against this loss. Clear? So whenever you are repaying amount at a premium, you have to book that loss against some reserve. So first of all, you have to use security premium if at all you have. Whether old or while issuing new shares, you have earned some premium, you can use both of them. Okay, to write off premium on redemption. Clear? And after this, if there is still some shortfall, you can use free reserves. Okay. You know what are free reserves. Okay. Now suppose you have security premium worth rupees 5,000. Then you can use some free reserves worth 5,000 so that the entire amount of premium on redemption is written off. Okay. So whenever the shares are redeemed at a premium, okay, you have to make these two equations. If shares are redeemed at par, only first equation you have to make. Okay, this. And if you are issuing or rather redeeming the shares at a premium, you have to make both these equations. Okay, that's it. Now I'll tell you the entries which you have to pass in order to record these entries. Okay. Now, just a minute. When redemption takes place, okay, we may need some amount of cash. Okay, so when we keep aside some amount in investment, it will be obviously sold for redemption of preference shares. So very first entry which you may receive is sale of investment. Okay, in this sum, a balance sheet will be provided to you, and in adjustments, it will be given that investments which are worth rupees 10,000 are sold for rupees 15,000. Like some transaction will be given. Okay, you have to pass entry for that. Okay, so when you sell any investment, okay, what comes in? Money. Okay, so you will debit bank account debit. Clear? And what is going out? Investment. So to investment. Clear? Very simple entry. If you have sold investment worth rupees 10,000 for 10,000, then in debit it will be 10,000 and in credit also it will be 10,000. Clear? Very simple. That investment is sold at par. But as I told you, that investment worth 10,000 is sold for 15,000. So equation is not matching. We have earned some profit. So profit always credit, debit all expense, credit all incomes. So you have to book that 5,000 on the credit side because these should match. Debit credit columns should match. And that profit will be transferred to P&L account. So to P&L account. Understood? Very simple. When you sell any investment, money will coming and investment will go out. So bank account debit to investment. If it was worth 10,000 and sold for 10,000, then there won't be any P&L account anymore. Simply bank to investment 10,000. But if you're selling it at a higher price, what will happen? It will be bank account debit to P&L and to investment. Okay, because investment is going worth only 10,000. So where is that 5,000 credit? It will be given. to this, if you are selling, so in bank, how much you are receiving? Only 8,000. Okay. And investment is going worth rupees 10,000. So there is short balance on the debit. So it will be debited by 2,000 and the loss will be transferred to P&L. So instead of crediting it to P&L, it will be debited to P&L. Okay. So P&L account changes place according to profit or loss. Okay. Debit all expenses and losses, credit all incomes and gains. So P&L debited whenever there is a loss and it is credited when there is a gain. Okay. So this is very common entry which you will receive. Okay. Another entry which you will receive in redemption of preference share is that in the balance sheet they will give you that the company made a final call. Company made a final call. We just saw what is the entry for final call. Do you remember, students? I'll just take you to that page again. I'll just move this bold, the headings. Okay. So entry for final call are, look here on the right hand side. Okay. Equity share final call to equity share capital call. And when you will receive money, bank account to equity share final call. Okay. So these entries will be there repeated. Okay. If you want, I'll write it again. I'll just copy and paste there. Final call made. One more thing is that, see, you cannot redeem a partly paid share. Okay. So in case preference shares which are to be redeemed is partly paid, in that case, you have to pass entry for final call. Okay. I'm talking about preference shares. Huh? So this will be preference. Okay. The entries for equity and preference for issue of shares are same. Only the word will change. Instead of equity, it will be preference. Nothing else changes. Okay. In case of issue of shares, whether it's equity or preference, entries remain as it is. They don't change. Okay. So final call entry in case of preferential capital, if we have to redeem, they have to be fully paid. So we have to make a final call. So entry will be preferential final call account debit to preferential capital. And when you will receive money, bank account debit to preferential final call. Simple entries. So this may be there, I'm telling you. Okay. One more thing which they may give as a part of adjustment is they will tell you that some calls in arrears are received. You know what is call in arrears? The money which was not collected on issue of shares on first or final call is now received. Okay, so I'll write calls in arrears received. Okay, they may give like this. Call in arrears received. So simple. Whenever you are receiving money, which account is debited? Bank. Okay, so just write bank account debit to calls in arrears account. Simple. Whatever amount they said is collected, you write that down. Clear? I hope you're understanding this sum. Okay. So these are additional entries which will be there in your sum. Okay. Once you understand now only, it will be very easy to solve those sums. Right? Okay. Now I'll teach you the main entries which you need to pass. Okay. Now these are two equations. Okay. The entries are based on equation only. The entries are based on these two equations only. Whatever entries related to redemption of preference shares are there in these two equations. Okay. Okay. I'll tell you where to start. Okay. We can start with fresh issue of shares, then transfer to CRR, then redemption, then writing of premium on redemption. Okay, so these entries can be in any order. There is no fixed order in which you have to write entries. Okay, but always we will first make arrangement for new shares, isn't it? Then only we'll be redeeming the old shares. It's logical, isn't it? Because that's the law. At first, raise the capital to the extent, then you redeem the shares. Clear? So we'll start with first issue of new share capital, then we'll create CRR, then we'll pass entries for redemption of preference shares. In that, two entries will be there. One, redemption becomes due and redemption made. Okay? And then writing of redemption on premium on redemption. Clear, students? I'll write here. Okay, we'll start with this one. I'll just insert one line here so that I can give them numbers. So it will be convenient for you to remember. Okay, so issue of share will be first entry for you. Then CRR creation will be second entry. Okay, then for redemption, okay, two entries need to be passed. So these two equations, okay, we need to pass entry. First, I'll write here 3 on top of this 3. Okay, and one more is there, so I'll write 3 and 4. So two entries on this equation. Clear? Then number 5 will be premium on redemption. 5. Clear? These basic 5 entries will be there. Apart from those 3 which I showed you. Okay. So shall we start? And I just keep this pre-reserve to the right so that we have more space here. You can see the equation while writing the entries. That is the idea. Okay, so these two equations you need to make. I hope you have understood these 3 entries, which maybe will be additional entries than those basic entries. Okay, so 3 entries we have already recorded here. So I'll go for the 4th one. Now we'll follow that order 1, 2, 3, 4, 5. Okay, which is the first entry we'll pass, students? As I told you, first entry will be issue of new shares. So new shares can be equity or preference. So when you sell new shares to public, what will be the entry? You will receive money. Okay, you will receive money. Okay, and it can be on account of equity or preference, right? So the entry will be bank account debit. I'll write 4th one. New issue. Okay, so it will be bank account debit to equity share capital or preference. Anything is fine. कोई भी issue हो सकता है. Preferential capital. Okay, sometimes share may be issued at a premium, so it can be to securities premium account. Okay, so when you are making a new issue, the entry will be bank account debit to either equity or preferential capital, and if you are selling it for a higher price, to security premium. Say for example, the equity share capital which was raised is suppose 50,000. Okay, and you issued these new shares to public at a 10% premium. So how much premium you must have collected? 5,000 on 50,000 is 10%. So in bank, how much you must have collected? 55,000. Okay, I'll repeat again. Okay, in our equation, the first entry which we are passing is for issue of new shares. New shares can be in the form of equity or preference. Okay, suppose we are issuing equity or preference shares worth 50,000 at a 10% premium. Okay, so what will happen? You will receive money, bank account debit. How much? 50 plus 5,000 for premium, 55,000. Out of that, capital is how much? 50,000, and premium is how much? 5,000. Very simple entry. Clear? So this was the entry for sale of new shares. Clear? Now what is the second entry? We have to create CRR. Okay, so we have created CRR worth 50,000. So whatever reserves you have used, say for example, you have used PNL and general reserve. Suppose you have used PNL account worth rupees 15,000 and 35,000 from general reserve. Okay, suppose this is the case. Okay, clear? So you are creating CRR out of PNL and general reserve. You needed 50,000 and you are using PNL and general reserve. So I just told you few minutes back that when a transfer entry is there, okay, whichever reserves you are using will be debited and the reserve which is created will be credited, right? In issue of shares, I told you that you are transferring share forfeiture balance to capital reserve. So it was share forfeiture to capital reserve. Now here which reserve we are using? PNL and general reserve. Okay, so those two will be debited and which will be credited? Capital redemption reserve. So let us do it. PRR created. Entry will be PNL account debit. PNL use was 15,000, right? General reserve 35,000. To capital redemption reserve. How much? 50,000. Clear? So we have fulfilled the condition. Okay, now we can go for the redemption. Clear? So this 1 and 2 are done. Now 3 and 4. Okay, 3 and 4 you should always remember will go together. First, you will declare that the shares are being redeemed. Okay, for that first entry will be there. Okay, now as I told you, when we cancel out shares in case of forfeiture or redemption, we are cancelling the share capital. So it will be debited. Okay, so this preferential capital will be debited. Clear? So I'll write preference shares due or redemption. Okay, so entry will be preferential capital account debit. We are paying extra, so that's a loss. So premium on redemption. Will also be debited. Clear? Since it's a loss. To whom this amount is payable? Preference shareholders. To preference shareholders account. Okay, that is the amount becomes due for payment. What is the amount? I think it was 1 lakh. No? 1,10,000. Capital we are redeeming 1 lakh. Premium we are redeeming 10,000. So total amount payable to preference shareholders is 1,10,000. I hope this is clear. When we redeem, we cancelling the shares. So whenever we cancel shares, it will be debited. Clear? So preferential capital account debit. Premium we are paying extra 10%. That's our loss. So premium on redemption account debit to preference shareholder. It is payable to preference shareholders. Student, let there be any sum. Not a single entry will change. Okay. Entries will be as it is. You need to calculate just the amount and fill in the values. Okay, in the entries. Okay. Even if you practice 2-3 sums, this chapter will be done. Okay. So now this amount becomes due to preference shareholders. Now it will be paid logically, isn't it? Preference shareholders paid. Overpaid. So when we pay amount, debit the receiver. So preference shareholder account debit. to bank account. Clear? Whenever money coming in, we debit bank. Whenever we are paying, credit bank. How much amount we will pay? 1,10,000. Clear? That's it. Okay. So redemption, third and fourth entries also done. Okay, we started with new issue entry, then CRR entry, then redemption 2 entries. One it become due and we pay. That is fourth entry. Now writing of this premium on redemption is fifth entry. Okay, so I'll write entry. Which reserves we are using? Say for example, security premium we are using 5,000. Just give some space so that you can understand here. Okay. And in free reserves, we are using suppose P&L account. Okay. So again, transfer is there. From reserves, we are writing off premium on redemption. So reserves which we are going to use will be debited. So which reserve will be debiting? Security premium account debit, P&L account debit, to premium on redemption account. Okay. So entry will be 8 to write off POR. Okay. Write off POR. Okay, which reserves we are using? Security premium account debit, and P&L we are using, right? P&L account debit, to premium on redemption. Okay. In earlier entry, in sixth entry, you can see premium on redemption was debit. Now we are crediting it, so it is getting cancelled out. Okay. So 5,000 we used from security premium, and 5,000 we used out of P&L. Okay. Clear? That's it. Okay. Only these many entries you should learn properly to solve this sum. Okay. So we have covered a lot in today's lecture. So I'll stop here. If any doubts, you can meet me tomorrow and ask and clear your doubts. Okay. Do watch video again if any doubts are there. Okay. So I'll stop now. Okay. Thank you, students, for attending the lecture. Bye. See you. Take care. The link can be used anytime to watch the video. Okay. Same link can be used. Just save it. Okay. Bye.